Hi everyone, welcome to Wikipedia World. Today we are going to start a new topic, derivatives. To explain this, let's take an example. For example, you and your friend, you got some 2 tickets of Kapil Sharma shows. But when you reach that counter, you get to know that all the tickets have been sold. You get to know that your friend's uncle can give you one recommendation letter, basis which you can get an entry for Kapil Sharma show. Now this ticket letter cost ₹1000. So what do you think? What do you need to buy? The ticket or the recommendation letter? Or either both of them? You need to buy both of them because the recommendation letter gives you the right to buy the ticket. So this recommendation letter is the derivative instrument and the asset is the ticket. So the underlying asset or security is the ticket for comedy show and the recommendation letter is the derivative instrument. This letter, it does not gives you the ownership of the entry to the tickets or entry to the comedy show, but it gives you that right to convey the ownership. And what will be the cost of this ownership letter, the recommendation letter? That will depend upon the cost of the underlying asset. So you can say that the derivative instrument derive its value from the underlying security. So you can say, what do you understand by derivatives? Derivative is a financial instrument that derives its value from one or more underlying assets. So in our example, the underlying asset is the ticket and the financial instrument is a recommendation letter. Practically, these underlying items could be like shares, debt instruments, stock index, commodities, foreign currency. We will discuss one by one in our further discussions. Now let's take few more examples to understand this concept better. A agreed to buy a shirt from B for ₹800 and A pays ₹800 to B while B promises to deliver the shirt after 1 week. For a contract, two things are required. That one person is used to pay for that commodity and the other person has to deliver the promise. So in this transaction, there are two elements of the transaction that the price and the goods and services being delivered. So one transaction is settled that you are paying up the price. Now let's take one more example. A agreed to buy a shirt from B while A promises to pay in 4 monthly installments. Now here B has delivered the goods and services but the payment has not been made. Again, out of the two elements, one element is being satisfied. So such type of transactions are called as spot transaction. So a spot transaction is the one where one of the element, at least, that is either the price or the goods and services is tendered at the time of contract. Now let's take one more example. Let's say that there is a farmer. A farmer will produce wheat after 6 months. So as of now, the farmer does not hold the commodity. He'll produce the wheat after 6 months. Let's say after 6 months, he'll produce 50 tons of wheat. Now wheat prices are fluctuating. So he wants to make sure about the price that he should get for his crop. Now there is another person, let's say B, who is a bakery owner. So this mouse-checks man is a bakery owner who needs 50 tons of wheat at the time of next crop for his bakery business. He also wants to get certain that he'll get that quantity after 6 months. Right now, farmer does not have wheat and the baker does not need the wheat as of now. Farmer will produce it after 6 months and after 6 months, the baker owner needs 50 tons of wheat. So they both enter into a contract and negotiate that whatever production that will happen after 6 months, that 50 tons, you will sell it to me. So transaction does not happen on the spot and the prices will also be paid after 6 months. But what will be the price? That is fixed. That let's say that after 6 months, I'll pay you 10,000 per ton. So the prices are fixed, the quantity is fixed, the parties are there. However, neither the price is paid at that moment nor the goods and services have been delivered. Such type of contract is called as forward transaction. So to differentiate between the spot contract and the forward transaction, spot, at least one element is tendered, either the price or the goods and services, and in forward, both the components are exchanged at a specified future date. The next difference is In spot contract or in a spot transaction, both the parties they transact basis their present capability. However, in forward transaction, right now neither the farmer is capable of producing 50 tons of wheat nor the baker is in a position to pay back. So you can say that in a forward contract, a leveraging of capabilities is involved. There's a risk also because no down payment is involved. So the buyer might contract to buy a larger number of goods or services with an hope that he will derive some benefits from the price difference that will be caused after 6 months. Let's say today he has to pay 10,000 bucks for 50 tons of wheat. After 6 months he might have to pay 20,000. So at present he does not know that, but there is a perception that might be the price will rise, so he entered into a forward contract. So in a forward contract things are certain because either one or the both the components are present, while in a forward contract there is a uncertainty regarding the payment or the delivery of goods and services. Okay, right. So now let's discuss who all are the participants of derivative market. There are three types of participants. One is hedger, other one is speculator, and the third one is arbitrager. Now what are hedgers? Hedgers enter into this derivative market in order to reduce the associated risk because of the price fluctuation, like the way they entered into forward contract. So the baker man is a hedger because there is a risk that the price may hike after 6 months. So to reduce this risk of rising of prices, he hedged it by entering into a forward contract. So the baker is the hedger here. The next is speculator. Let's say today the stock has been closed at 200, right? And there might be a chance that the stock sharply rise, or you can say sharply fall. It will fall a lot. So a speculator is the one who take the extra leverage by betting for the future movements. He's not sure. His whole theory is based on certain rumor, so they can increase both the potential gains and the potential losses by usage of derivatives in a speculative venture. And the third one is arbitrager. Arbitrators are the one who take the benefits of the discrepancy between the prices in two different markets. To explain, let's say one calculator is available in Indian market of rupees 300, and at present the price of the rupee in comparison to dollar is, say, let's say 100. So $1 is equal to rupees 100. So if the calculator cost rupees 300 in India, it should cost $3 in USA, and considering that there is no other flotation or exchange charges. But what if that calculator costs just $2.5 in America? What an arbitrator can do, he can buy that calculator from America for $2.5 and can sell it for rupees 300 here. So he has actually spent rupees 250 and has gained 300. So there is a net gain of rupees 50. So arbitrator, he took the benefit because of the discrepancy in the prices of the same commodity in different markets. Now if you think, what are the features of derivatives there? What are their characteristics? Derivative is the trade at a lowest possible transaction cost, and they are traded globally. So they can be closely matched with the specific portfolio requirements. And apart from that, derivatives do not alter their characteristics because of the change in the underlying asset. So for underlying asset, you can say if the underlying asset is a share or a commodity or a forex, the characteristics of derivative will not change. It will remain same. So once you get the concept of derivative, it can be applied on any of the transaction because it does not lose its originality. Its features will remain same, and the value of derivatives will always depend upon the value of its underlying assets. So if there is any change in the underlying asset value, it will also affect the value of derivative. So as of now, you have understood that derivatives, it does not give you any ownership of the asset, but it promises or convey you the ownership. How these derivative contracts are dealt, they can be traded in two ways. One is exchange traded and the other one is over-the-counter derivatives. Exchange traded includes those products and contracts which are traded on the stock exchange. That's why they are called exchange traded contracts. And similarly, the products and the contracts which trade outside the exchange, they are called over-the-counter derivatives. So exchange traded contracts are standardized contracts. Their quantities and their quality that does not customize according to the need of the investor, hedger, speculator, the contractor. And the counterparty for each transaction is the exchange. While over-the-counter derivatives, it is usually done between two financial institutions. Since they are not on exchange, that means they are not listed. They are not listed, so they can be customized according to their needs. And the traders who dealt in such contracts are usually larger than the exchange trader derivative transactions market. Now there are various types of derivative instruments which are there in both the markets. Some which are traded in exchange traded and some are traded on the over-the-counter market. Now the different types of derivative instruments are like future, options, swaps, cap, floors and collars. Now we are going to discuss them one by one later in our discussion. After all these, futures and options are the most populated derivative instruments which are traded into exchange. Now before discussing these things, let's discuss the three generic contracts which are in the derivative market. The first is forward contract, the other one is futures contract, and the third one is option contract. We are going to discuss one by one each type of contract. A forward contract. We have already discussed what is forward transaction. A contract for that forward transaction is called as forward contract. So you can say that it's an agreement to buy or sell an asset. In our example, that asset was wheat on a specified future date. That means 6 months as per example. For a specified price, 10,000. One of the parties assumed a long position and other assumes a short position. So long position means one party agreed to buy the underlying asset, that's a long position, and short position is one of them party agrees to sell the asset. So in our example, the farmer was at the short position and the other party is the baker who is at the long position. This forward contract is traded over the counter. So it's a over the counter product. In India, forward contract is tremendously being traded because such type of contracts, they are generally negotiated on one-to-one basis. They are very flexible. They can be customized based on the user requirements. They can negotiate regarding the quantity, the quality, the delivery time, and also the place. So the parties are free to decide regarding all these terms and conditions. And that's why they are extensively used in India to hedge against risk. So there are various advantages of foreign markets also, but there are certain problems too. The first is they can be used as a hedging tool. Now how? So if we take our example, when the farmer enters into that contract, forward contract with the bakery owner for selling 50 tons of wheat, after 6 months, he is hedging himself against the fallen prices. On the other hand, the bakery owner, he is hedging against the lack or shortage of the supply. So both of them have certain knowledge regarding the future expect, and regarding that risk, they are hedging themselves or mitigating that risk by entering into a forward contract. The next is the help in price discovery. Because since let's say that both are very certain that the prices might fall or there is a shortage of supply of that good, it helps them to discover the price prior to 6 months. So it also helps in discovering the price. But there are problems in forward market. The first is liquidity. Now why liquidity is a problem? They are as per the requirement of the trader, not customized. So it's an agreement between the farmer and the baker for delivering 50 tons of wheat as per their own requirement. So a third party cannot even enter into that contract because it might not be as per his requirement. And there is a possibility of such an happening that either the bankrupt is not in the position to pay back that amount after 6 months, because both the things, the delivery and the price, they are not transacted at the same time. So that uncertainty is there, which causes a problem of liquidity. The next issue is because of the inadequate knowledge. This is because there is no regular interface between the buyer and the seller. So both are not in a position to assess the actual credibility or what will happen subsequently after entering into the transaction. So since it is a contract, both the parties, they utilize as much information that is available to them, and this may result in inefficient transactions because of some inadequate discovery, you can say, of the price or the quantity of the goods and services. And then the next problem is the counterparty risk. Counterparty risk means one of the other party, they are not in a position to honor their commitment. But there are ways to eliminate these problems. Like liquidity could be eliminated because there are very large number of traders in the derivative market. So the demand and supply of the goods and services, they keep on shifting from one person to another, and this will help to eliminate the problem of liquidity. So the original contract will stay, but it just changed the number of hands. The inadequate knowledge problem could be eliminated by pooling of knowledge of multitude of seasoned players in the exchange, because there are certain participants who have that knowledge with them. Interacting with them, sharing with their knowledge will help you to understand the other party's transaction. And the counterparty risk, that limitation could be eliminated by having a clear house facility. So the clear housing, what they do, that keeps a margin money from both the participants, and they ensures that the transactions are actually settled. The other type of contract is the future market, the future contract. Now if these forward contracts, they are dealt on an exchange, that is, you can say an exchange traded form of forward contract is called as future contract. So a future contract is an exchange traded forward contract to buy or sell a predetermined quantity of an asset on predetermined future date at a predetermined price. So again, there will be two players, or there could be three players. There will be, like, you can say there's a bilateral or a tri-party agreement. Again, one will be at a long position and other one will be at a short position. But since these future contracts are traded on an exchange, so they are customized. Since they are customized, they should be valued. And how they are valued? Theoretically, they are valued basis their future price or their fair price. And what is fair price? It is that price which came after adjusting the cost of carry, or you can say the carrying cost at a future late or a later date. What is cost to carry? If you have blocked your funds for 6 months, so the interest that you would have gained, like if you have sold it today, you get it 10,000, but since you are selling it after 6 months, whatever that interest cost is there for the amount actually paid for an asset on a spot purchase is called as cost to carry. So to compute cost to carry, you take the total interest cost over that period, and if that during period you earn certain revenue income, or you can say that some dividend is there, you have to reduce that. So net cost to carry is the interest for the time period, whatever the predetermined future period is there, less the expected dividend yield. So generally what happens, that whatever the fair price is there for a future contract, that is generally at a premium from whatever the spot price is there going on. Let's do an example to understand it. A future contract is available on a company that pays an annual dividend of rupees 5 and whose stock is currently priced at rupees 200. Each future contract calls for a delivery of 1000 shares of stock in 1 year. Daily marketing to market, an initial margin of 10% and a maintenance margin of 5% is being paid. the corporate treasury bill rate is 8%. So 8% of 200 is the interest cost of that market, but you are receiving a dividend of 5 rupees. So the cost of delivery is 8% of 200, right? Less rupees 5, that will be the cost of asset. Today the spot price is rupees 200. With the spot price you will add up the cost of delivery, which is that you have just computed 8% of 200 less rupees 5. If you write it mathematically, it will be S, which is the spot price, plus S into the carrying percentage, whatever the cost of carry is there, less the revenue income. 200 is the spot price, plus 8% of 200, which you will give the interest cost, less the income that you will earn, which is 5. So 211 is the fair price for the stock. Now what if the company stock decreased by 7%? What will be the change in the future prices? So if the company price decreased by 7%, what will be the price of the future? 200 less 7%. The interest will be on the less 7%, that is 93% value, 8%, and reduce 5 dividend income. You will get that the fair price will be 195.88 for that stock. Now there is also one question that as a result of the company's stock price decreases, will an investor that has a long position means the position to buy that asset, in one future contract realize a gain or loss. Now he has a right to buy that asset. Stock price has reduced and has reached to 195.88. The fair value at which he has purchased was 211. Market price is 195.88. So there is a loss. He has 1000 shares of that. So to compute the loss will be the difference between 211, which is his purchase price, less the fair price as of now, which is 195.88, multiply by 1000. So the investor will have a loss of 15,120. So by now you have understood the difference between the forward contract and a future contract. So forward contract, it's traded between two contracting parties, but in future one party's exchange. So in forward there is a risk of counterparty risk, but since this is being customized and traded over the exchange, the futures are standardized contracts and there is no counterparty risk. So whatever problems are there in the forward contract, they are being eliminated in the future contract because they are standardized. So liquidity problem is not there, price could not be discovered, and there is an inadequate knowledge is there. Vice versa, in futures, being a standardized market, the product is standardized, there is no liquidity issue in that. We can easily discover the price and the information is also widely available. So at present in India, if I give an example for a forward market, you can take an example of currency market where the forex are being dealt. And for futures, there are commodities market, there are index futures. So you got to know the difference between forward and futures. Theoretically also from exam point of view, this difference is very important. It's been asked several times in our examination. Thank you. That's all we are going to discuss today. Tomorrow we are going to discuss regarding further options and further contracts. Thank you. Have a nice day and keep smiling.